Welcome to the Deep Dive. Today, we're getting into something pretty fundamental for understanding markets. Panic selling. That
Yes.
quick, widespread rush for the exits, often based more on feeling than facts.
Exactly. It's that kind of dynamic that can turn a small dip into, well, something much bigger, much faster. And in this deep dive, we want to explore that, but specifically how it might affect, the newer generation of investors, Gen Z.
Right. We've looked at a mix of sources analyses of historical panics, plus some really interesting stuff on how Gen Z invests today. The goal here is to kind of sift through it all, understand the core triggers, the psychology, and what it means now without you feeling totally overwhelmed.
Yeah, cutting through the noise.
So let's jump in. What actually defines panic selling? Like, what are we looking for?
Okay, so the anatomy of it. The sources point to a few key things. First, speed. It's dramatic. Things move very, very quickly. Yeah. And second, it's widespread. Selling hits lots of different assets, not just one corner of the market. But maybe the biggest thing is the irrationality. It's really driven by fear, by emotion, not a cold, hard look at, fundamental value.
And that fear, it sort of feeds on itself, right?
Oh.
Prices drop, more people get nervous, they sell, prices drop more.
Precisely. It's a classic feedback loop. And our sources, they highlight market mechanics that can actually make this worse. Take margin calls, for instance.
Margin calls.
Yeah.
Explain how they pour fuel on the fire, so to speak.
Sure. So investing on margin means you're borrowing money to buy assets, hoping for bigger returns, leverage, right?
Right.
But if the value of your stuff drops sharply, your lender can demand repayment. That's the margin call. You might have to sell assets, maybe stuff you didn't want to sell, just to cover the loan.
Even if you think it'll recover later.
Exactly. It forces liquidation. It turns a downturn into a must-sell now situation for some, pushing prices down even more. Leverage is key here.
Wow. It's like being forced to sell low.
Okay.
And then there are stop-loss orders. How do they fit in?
Yeah, stop losses are basically preset orders to sell if a price falls to a certain level. The idea is damage control, limiting your losses.
Sensible enough on its own?
On its own, maybe. But picture prices falling fast across the market. Suddenly, waves of these stop-loss orders get triggered all at once. You get this flood of sell orders hitting the market just when buyers are already scarce. It sucks liquidity out.
So it's not just individual emotional reactions. The systems themselves can accelerate the panic. Okay,
Yeah.
so stepping back, what creates the conditions for this kind of fear-driven selling to even happen?
It's a real mix, a complex interplay. Psychologically, things like loss aversion are huge. We feel losses way more intensely than gains, right?
really.
And herding behavior, just following the crowd. Plus, personality traits matter. Some people are naturally more anxious, and, well, sometimes we just overreact to news.
That makes total sense. We hate losing, and if everyone else is running, the instinct is to run too. But it's not just in our heads, is it? There have to be external triggers.
Oh, absolutely. Big economic events are critical. A housing bubble bursting like we saw, or a sudden geopolitical shock. Those create the initial uncertainty.
The spark.
Right. And then social dynamics kick in, how the media covers it, and especially now, how fast information and misinformation spreads on social media, that can just amplify the panic massively.
Okay, so I'm picturing it.
Hmm?
Some bad news hits, creates uncertainty. Our psychology makes us freak out about losing money.
Yeah.
Then the news, Twitter, whatever, blasts this fear everywhere, and boom, it snowballs.
That's a pretty good summary. And underneath it all, often there's this erosion of trust. Trust in the market's stability, trust in institutions, maybe even trust in the information you're getting. When that trust goes, markets get fragile.
That gives us a really solid framework. So let's bring this to life with some history. The sources talk about past crises. Where should we start? 1929, the Great Crash.
Yeah, 1929 is like the textbook case in some ways. You had the Roaring Twenties, huge optimism, but loads of speculation, people borrowing heavily margin buying to play the stock market.
Built on shaky ground.
Pretty shaky. There were underlying economic issues too, overproduction, trade problems. So when the market turned, the psychology just flipped. Panic spread like wildfire. Herd behavior took over, the big takeaway. Widespread borrowing without understanding the risk is, well, dangerous.
And the tech back then actually made it worse, right? The ticker tape couldn't keep up.
Exactly. That delay, the inability to get real-time info, just added to the chaos and fear. And for ordinary folks, especially newcomers who were deep in debt from margin buying, those margin calls were devastating, forced selling at rock-bottom prices.
People were wiped out.
Completely. And even the big banks trying to step in couldn't stop the slide.
So you had speculation, weak fundamentals, investors in over their heads, and slow communication creating this perfect storm. And the media. Initially optimistic, then just documenting the disaster?
And probably amplifying it too, yeah. If you're thinking about relevance for today, 1929 really showed the systemic risk of too much leverage without enough financial literacy. It directly led to things like the SEC, regulations to try and prevent a repeat.
Okay, huge lesson learned there, hopefully. Let's jump forward. The 2008 global financial crisis felt very different, much more complex financially, but panic was definitely central. What drove it?
2008, yeah, the roots were in the U.S. housing market, specifically subprime mortgages loans to people with weaker credit. These risky loans got bundled up into really complicated products, MBSs, CDOs, and sold globally.
Sliced and diced mortgages, basically.
Pretty much. Super complex, hard to value, plus big financial institutions were heavily leveraged themselves, lots of debt. Then Lehman Brothers collapsed in September '08, and that was the trigger for full-blown global panic.
So the complexity hid the risk.
To a large extent, yes. The takeaway there was about the hidden dangers in these complex instruments and the risk from highly indebted institutions spreading contagion really fast.
And psychology. Loss aversion again.
Absolutely, big time. We also saw something called hyperbolic discounting, basically, prioritizing escaping pain right now over long-term thinking. So lots of just selling anything to get out.
Indiscriminate selling.
Yeah, and what was interesting in '08 was seeing both individuals reacting, but also these massive institutions forced to deleverage, selling huge chunks of assets, which just spread the panic further.
And the media's role then? Much faster news cycle than 29.
Much faster. Even if the media struggled to explain the complex finance stuff clearly, the sheer volume and intensity of the coverage definitely ramped up the fear and crushed trust in the system. The lesson from '08 focused a lot on the shadow banking system, the less regulated parts, and the whole too big to fail problem. That led to bailouts and reforms like Dodd-Frank.
Okay, then just a few years ago, COVID-19 hits. The 2020 crash.
Yeah.
That felt unique, like an outside force just slamming the brakes on the world economy. How did panic play out then?
Totally unique trigger, yeah. A global pandemic, lockdowns,
Yeah.
just unprecedented uncertainty. Plus, an oil price war at the same time didn't help.
A double whammy.
Right. The VIX, the fear gauge, went through the roof. We definitely saw that intense fear of loss driving impulsive selling again, probably fueled by that get me out now bias. But the reaction was interesting.
How so? Because I remember hearing a lot about retail investors, maybe younger ones, actually jumping in, buying the dip.
That's a key point from the sources, yeah. There was initial panic selling, for sure. But you also had this wave of individual investors, many new to the game, seeing it as a buying opportunity. Meanwhile, institutions were mostly de-risking, selling off assets.
The real divergence.
And social media's role was even bigger than in '08. Spreading fear, yes, but also kind of coordinating some of that buy-the-dip energy among retail folks.
Information and maybe disinformation spreading like lightning. And the government response was also incredibly fast in 2020.
Crucially fast and massive. Central banks, governments stepping in, that's widely seen as preventing a much, much deeper crisis and fueling that relatively quick, though uneven, market rebound. It also just accelerated the shift to digital finance and really highlighted the challenge of navigating this super connected, fast-moving information world.
Okay, so looking across these crises, 29, '08, 2020, we see psychology leverage information flow as constants, but the context, the triggers, how it unfolds, that really changes. Which brings us right to Gen Z. Who are these investors, and what makes their potential experience with panic unique?
Right, Gen Z, born roughly 1997 to 2012, they're entering the investment world differently. They often start younger, like around 19. Goals are varied, emergency funds, retirement, but also shorter-term stuff like travel.
Interesting. And their attitude towards risk.
Generally, they report being more comfortable with risk. They're drawn more to volatile things, crypto, meme stocks, that kind of thing.
Higher risk tolerance, okay.
Yeah.
But the sources also flagged a potential issue, didn't they? Something about financial knowledge.
Yes, that's a really important point. Despite starting early and being open to risk, research suggests Gen Z, as a group, tends to score lower on financial literacy tests compared to older generations. And maybe even more worrying, some data shows their self-assessed financial knowledge might actually be declining.
So potentially a gap there, willingness to take risk, but maybe not a full grasp of what that risk entails.
It's a potential mismatch, yeah.
Yeah.
And where do they get their info? That's critical.
Where are they getting it?
Overwhelmingly digital. Social media is huge, about 48%. Internet searches, 47%. Family and friends still matter, around 45%. But crucially, something like 42% report getting financial advice from social media. Compare that to only 27% using traditional advisors.
Wow, that's a big shift. So TikTok, Reddit, Finfluencers, that's the ecosystem.
Very much so. And investing apps are ubiquitous. About 65% use them. So they're immersed in this digital world for finance.
A world that's often unregulated, full of hype.
Yeah.
Sounds like a recipe for FOMO, the fear of missing out and maybe following the herd.
It can definitely foster FOMO, yeah. And that reliance on a sometimes biased digital ecosystem, it can make them more vulnerable to impulsive decisions based on what's trending rather than solid research. The ease of access is great, but judging the quality of info is tough.
Let's unpack some of the things they're investing in. Crypto and meme stocks, why the appeal, and what are the panic risks there?
Well, crypto feels inherently digital. It's 247, seems innovative, that appeals. Meme stocks often catch fire in online communities, tapping right into that FOMO nerve.
Get rich quick, or feel part of something.
Maybe a bit of both, but the core issue is volatility. Both are often driven way more by sentiment, by online buzz, than by any underlying value. That makes investors super vulnerable to sharp swings, emotional reactions, and, yeah, potentially panic selling when sentiment shifts.
The GameStop saga really highlighted the power of online communities and easy trading apps, didn't it? What did that show us about younger investors?
It was a huge demonstration of collective retail power, facilitated by platforms like Reddit and those user-friendly apps. Now, the initial squeeze wasn't panic selling by the main group, but think about all the people who jumped in late.
Chasing the hype.
Exactly. Driven by FOMO. Many of them got burned badly when the price inevitably crashed. It was a stark lesson in the dangers of sentiment-driven investing detached from fundamentals.
And we've seen major crypto crashes, too. Terra Luna, FTX, big lessons there, especially for Gen Z who might be heavily invested.
Brutal lessons, yeah. Huge volatility, contagion risk, how problems in one part of crypto can spread rapidly. Research after Terra Luna suggested smaller, maybe less informed investors, likely including many Gen Z, tended to exit later and lose more.
Ouch.
It just hammered home the need for serious due diligence, understanding the massive risks, and the potential for everything to unravel quickly in that space, especially crucial for newer investors.
Okay, so pulling this together, Gen Z, early start, digital natives, drawn to volatile assets, rely heavily on social media, lower financial literacy. What makes them potentially more susceptible to panic selling?
It feels like a convergence of factors. Those digital tools are a double-edged sword, right? Social media gives access, community, but it's also full of noise, hype, FOMO triggers. A lot of Gen Z admit FOMO drives investment choices.
The fear of missing out is a powerful motivator.
Hugely. Then you've got the investing apps themselves, the gamification animations, notifications. It makes it engaging, sure, but it might also encourage more frequent, maybe more speculative, emotional trading.
Yeah.
That can make users more prone to react impulsively, to panic when things get choppy.
Though the very design could nudge them towards emotional reactions rather than thoughtful ones, almost like treating it as a game.
There's that risk, yeah. And this digital environment can amplify existing biases too. Overconfidence, thinking you know more than you do. Confirmation bias, only seeking out views you already agree with in online echo chambers. Meme investing. It all gets magnified online.
A digital echo chamber effect.
Right. Combine that with lower financial literacy and heavy reliance on social media. It looks like a setup for more impulsive, potentially panic decisions during market stress. There's this concept of social amplification of risk. Online buzz can quickly validate and accelerate a rush for the exits.
And the easy access itself? Low fees, fractional shares.
It democratizes investing, which is great in theory. But if it's not paired with solid understanding, that ease of access can become a vulnerability. It just makes it easier to act on panic during volatile times.
It's a challenging picture. But understanding these vulnerabilities is the first step. So what can actually be done? How can we help Gen Z build resilience against panic selling?
Education is absolutely fundamental. We know most adults wish they'd learned more about finance earlier. For Gen Z, who self-teach online, the education needs to be where they are engaging, digital first.
What should it cover, beyond basics?
Definitely beyond basics. Risk assessment, understanding investment psychology, their own psychology long-term principles, how to critically evaluate different products. Making it relevant and digestible is key.
So not just what's a bond, but how not to freak out when your bonds go down.
Exactly. And linked to that, critical media literacy is vital. Since they're getting so much info from social media, they need skills to tell good advice from hype or scams.
Spotting the snake oil.
Pretty much. And platforms have a role too. responsible design. Maybe fewer gambling-like features, more built-in, unbiased education. Regulation might need to look at standards for finfluencers and platform accountability as well.
Okay, education, media literacy, better platforms. What about, like, behavioral tools or nudges? Things to counter impulse.
Behavioral science has lots to offer. Simple things like encouraging a pause, a cooling off period before trading during high volatility, helping investors identify their own emotional triggers, having a plan and sticking to it.
Pre-commitment strategies.
Right. Platforms could even build in speed bumps during market chaos or strongly promote things like dollar cost averaging, investing fixed amounts regularly, which takes emotion out of timing the market. It's about encouraging discipline.
Makes sense. And what about traditional advice? Financial advisors, institutions? Gen Z isn't using them much now. Can that change?
It's a challenge. Cost, distrust, maybe just lack of awareness are barriers. But trusted human advice can be a powerful counter to panic. Institutions need to find ways to be more accessible, affordable, and relatable.
Now,
Maybe digital first or hybrid models, using communication styles Gen Z connects with, addressing their specific interests like crypto, not dismissing them. Building trust is paramount through education, transparency, focusing on long-term well-being, overcoming that trust accessibility gap.
so it's really about meeting them where they are technologically, culturally, financially,
Okay.
and giving them the knowledge, the tools, the support to make smarter, less emotional decisions.
Precisely. Building not just financial literacy, but financial resilience, emotional resilience in the face of market ups and downs.
This has been incredibly insightful. We've covered a lot, from the deep psychology of panic selling to how it might play out differently for Gen Z. It's clear that while human nature doesn't change much, the context, digital media, new assets is constantly shifting.
And that really highlights Gen Z's unique spot. Starting early, digitally native, huge opportunities, but also real vulnerabilities. Lower financial literacy, reliance on potentially unreliable online sources, gamification effects, social amplification. It's a complex mix.
But the path forward isn't about blocking access. It's about empowerment, isn't it? Better education, critical thinking skills, responsible platforms, accessible guidance.
Absolutely. Which leads to a final thought, maybe for you listening. As information moves even faster and market access gets even easier, how do you think that continuous evolution will shape investor behavior? The potential for panic in the future?
And, maybe more personally, what steps can you take to build your own resilience, your own informed approach in this ever-changing financial world? Something to really think about.
Definitely food for thought.
Thanks for joining us for this deep dive.